Market crashes feel sudden. One day everything looks fine. The next day, panic is everywhere. Prices fall, headlines scream, people rush for the exits, and the question everyone asks is, what just happened? But here's the truth most people never hear. Market crashes are not caused by numbers, they are caused by people. It's easy to think of the market as a machine. Charts, algorithms, data, complex models, and cold logic. But behind every price is a decision made by a human. Fearful humans, hopeful humans, overconfident humans. Even when trades are executed by algorithms, the code was designed by humans, trained on human behavior, and deployed to serve human emotions like greed, safety, and urgency. The market is not a machine, it's a crowd, and crowds don't behave rationally under stress. That's why crashes always feel shocking. Every crash feels like it came out of nowhere, not because problems didn't exist, but because markets don't crash when problems appear. They crash when confidence disappears. Problems can sit in the background for months or years. Rising debt, inflated valuations, bad economic signals, geopolitical tension, weak earnings, excessive speculation. Yet prices can keep climbing as long as people believe everything is under control. As long as investors believe the system will hold, they keep buying. But the moment belief breaks, the moment people stop trusting the story, selling begins. And the real driver of that selling is expectations. Markets don't move on facts alone, they move on expectations about the future. When expectations are high, prices rise because investors are pricing in growth, stability, and profit. When expectations suddenly collapse, prices fall fast because the future no longer looks safe. Crashes are not slow adjustments, they are rapid resets of expectations. At the heart of every crash is a psychological shift. The market goes from, "we'll be fine," to, "what if we're not?" And that single question changes everything. Because when uncertainty spikes, people don't calmly update spreadsheets, they react. Fear spreads faster than logic, and fear is contagious. One investor sells, another sees it and thinks, they know something I don't. Another follows, not because they analyze the situation, but because they don't want to be last. This is herd behavior, and it's one of the strongest forces in finance. In a crash, selling feels like safety. It feels like taking control. It feels like, at least I did something. And the market rewards action in many parts of life, so it makes sense that people default to action here too. But action doesn't always mean safety. Often it means locking in losses driven by emotion. Selling in panic is not a strategy, it's an attempt to escape discomfort. And markets are designed to punish that instinct because the worst emotional moments often happen near the best long-term opportunities. This is where one of the most powerful forces in human psychology appears: loss aversion. Losses hurt far more than gains feel good. A 10% drop feels more painful than a 10% gain feels satisfying. When prices fall, fear becomes overwhelming. Short-term pain dominates thinking, and long-term logic disappears. People don't sell because it's smart. They sell because the emotional pain becomes unbearable. They're not trying to maximize returns. They're trying to stop the feeling. And smart investors panic too. People assume education protects them. It doesn't. In moments of extreme stress, intelligence takes a backseat to emotion. Smart investors often have even more detailed stories to justify their fear: risk management, capital preservation, waiting for confirmation, reducing exposure until uncertainty clears. The words sound logical, but the energy underneath is still fear. The difference between winners and losers in crashes is rarely knowledge, it's behavior. During crashes, people love the illusion of getting out early. They tell themselves, "I'll sell now and buy back later." It feels rational, it sounds like a plan. But here's the problem: crashes don't come with clear bottoms, and re entering requires courage at the exact moment fear is highest. Most people don't get back in, they wait for clarity, but clarity comes after prices rise. Then they feel like they missed it, so they wait for another dip. When the dip arrives, fear returns and they hesitate again, and months turn into years. This is one reason markets fall faster than they rise. Fear compresses time. When people are afraid, they don't wait, they rush. Selling becomes urgent, buying disappears, and that imbalance causes sharp, violent drops. Recoveries take longer because confidence rebuilds slowly. In a crash, people all sell at once. In a recovery, they return one by one. The media amplifies this effect. Media thrives on drama, especially financial media. During crashes, bad news dominates, worst-case scenarios get the most attention, and fear multiplies. Constant exposure makes panic feel justified, even when the underlying fundamentals haven't changed as much as prices suggest. When you see red numbers all day, you start feeling like the world is ending, even if the actual reality is uncertainty is high and people are reacting. And when confidence breaks, volatility explodes. Volatility is just a measure of disagreement. When investors agree, prices move calmly. When investors disagree, prices swing wildly. During crashes, no one agrees on what anything is worth because the future feels unclear. That chaos is psychological, not mechanical. Prices move violently because the crowd is emotionally unstable, not because businesses are changing every minute. This creates a feedback loop that deepens crashes. Falling prices create fear. Fear creates selling. Selling pushes prices lower. Lower prices trigger more fear. The loop feeds on itself until something breaks it, and what ends a market crash is rarely a sudden piece of good news. Crashes often end when sellers are exhausted, fear peaks, and expectations reset. The market stops falling not because things are suddenly good, but because everyone who wanted to sell already has. The crowd runs out of panic. Recovery begins quietly. That's another reason people miss it. Recoveries don't feel exciting. They feel suspicious. After a crash, people don't trust the first bounce. They call it a dead cat bounce. They say it's a trap. They wait for confirmation. But the market doesn't wait for comfort. Early recoveries happen without participation. Confidence returns after prices rise, not before. Most people only feel safe again once a large part of the recovery is already gone. This is why crashes are inevitable. Crashes are not bugs in the system, they are features. They cleanse excess, optimism, reset unrealistic expectations, and remind investors that risk is real. A market without crashes would be unhealthy because it would create the illusion that prices only go up, encouraging more and more leverage, more speculation, and more reckless behavior. Crashes are the market's way of correcting human excess, but the real danger isn't the crash itself. The real danger is what people do during it. Panic selling, abandoning plans, destroying their own long-term strategy at the worst possible moment. That's where permanent losses come from, because the market can drop and recover. But if you sell at the bottom and don't re-enter, your portfolio doesn't recover. The market may heal, but your participation ends. And the biggest cost of panic is not the loss you took, it's the growth you missed afterward. Long-term investors don't enjoy crashes, but they understand them. They see crashes as temporary, emotional, and unavoidable. They accept volatility as the price of long-term returns. And most importantly, they prepare psychologically long before a crash happens. They don't try to predict exactly when the next crash will come, because you can't predict crashes reliably. No one can. The exact trigger is usually obvious only in hindsight, but you can prepare your behavior. You can decide in advance how you'll react, what you won't do, and what your rules are. That preparation is powerful because in the moment, emotions don't ask permission. This is where the calm advantage comes in. When everyone else is emotional, calm becomes an edge. Not because you're smarter, but because you're not reacting. Calm allows patience. Patience allows you to stay invested. Staying invested allows recovery. And recovery is where long-term wealth is built. History keeps teaching the same lesson. Every major crash feels unique. Every recovery feels unlikely. And yet markets recover again and again. The psychology never changes. Only the headlines do. Different decade, different crisis, same human behavior. Fear spikes, people panic, prices overshoot downward. Then the system stabilizes, expectations reset, and growth resumes. The cycle repeats because human emotion repeats. So here's the final thought. Market crashes are not tests of intelligence, they are tests of temperament. The market doesn't ask, how much do you know? It asks, can you stay calm when others panic? Those who can don't just survive crashes, they come out stronger, not because they avoided fear, but because they learned how to act in spite of it.